Most business owners and real estate investors know they can write off equipment and improvements, but the rules behind those write-offs are often confusing. You hear terms like bonus depreciation and Section 179, and it is easy to assume they all mean the same thing. They do not. In this video, we break down bonus depreciation and Section 179 using clear, practical language, what each one does, how they differ, when to lean on one versus the other, and how they fit into a long-term tax and cash flow strategy. By the end, you'll be able to ask your CPA better questions than, can I write this off? Let's get started. What bonus depreciation really is? Bonus depreciation is simply accelerated depreciation. For qualifying assets, instead of deducting the cost over several years, you can deduct 100% in the year the asset is placed in service. Qualifying assets typically include machinery, computers, furniture, and fixtures. What counts is when it has been placed in service. More than just having bought the asset by December, placing it into service makes it eligible for depreciation or amortization deduction. Here is where it gets super interesting. Bonus depreciation can create or increase a net operating loss. In most structures, if you don't have enough income to use against all that accelerated deduction, the unused portion turns into a loss that carries forward. The different thing about Section 179, another route to a first-year full write-off is through Section 179. It's available on slightly different asset classes and comes with much tighter limitations. There is an annual dollar limit on how much Section 179 you can claim. The moment your total qualifying purchases reach a certain threshold, the benefit starts to phase out. It was really intended for small and mid-sized businesses. Section 179 is tied to your taxable business income. You cannot use it to push your business into a loss. If your Section 179 election is larger than your income, because of those limits, Section 179 is frequently applied in a more targeted manner. Owners select particular assets, such as vehicles or equipment expenses, under Section 179 when they wish to manage how much deduction appears in the current year. How do the two work together? In real life, it's not a choice between bonus depreciation or Section 179. The tax rules generally apply Section 179 first, then allow any remaining qualified asset basis to run through bonus depreciation. That means you and your advisor can decide where Section 179 makes the most sense, often on items that do not qualify for bonus or where you want to cap the deduction, then let bonus depreciation apply to the remaining eligible assets. The goal is not to blindly maximize every deduction this year. The goal is to line up your deductions with your income. Real-world examples. You can picture. Consider a small construction company that buys $300,000 of new equipment. The business is profitable and expects similar income in future years. You may use enough Section 179 deduction to bring taxable income for this year down to a comfortable level, but not all the way down to zero. Then take bonus depreciation on some remaining assets if you want more deductions now. Consider a real estate investor turning over multiple units. He installs new appliances, fixtures, and other improvements that qualify as shorter-lived property. Instead of depreciating those items slowly, an advisor might recommend a cost segregation study to clearly identify them, use bonus depreciation on the qualifying pieces, and then get very specific with Section 179 on certain assets that are outside the building structure. In both cases, the choices are intentional. The write-offs conform to the owner's income, growth plans, and exit strategy. The hidden risks of overexpensing. If I can deduct it now, I should. That is a tempting thought. However, full expensing in the first year is not always the smartest answer. When you are aggressive in using either bonus depreciation or Section 179, this means carrying reduced deductions into future years. If your income stays strong, then later years show higher taxable profits with fewer deductions to offset them. Accelerated depreciation often increases the gain on sale that is treated as depreciation recapture, taxed at higher rates than long-term capital gains. It makes sense to accelerate, but an exit plan has to be devised. That is why we always treat these tools as part of a multi-year strategy, not a one-year trick. When does it make sense to slow down? There are very real cases where you may want to skip bonus depreciation or Section 179 and use regular depreciation instead. If your income is unusual unusually low this year. Maybe you are in a startup phase, dealing with a transition, saving deductions for future, higher income years may be wiser. Perhaps you also want to show smoother financial statements to lenders or investors. Match the trend of your income with your borrowing plans, bringing this into your planning process. So how do you put all of this into practice? That's a big question, and the answer is different for every business. But here are some steps. Step 1 is timing. Do not wait until tax season. Start the conversation before year-end, while there is still room to adjust purchases or the way assets are placed in service. Step 2 is information. Make a simple list of what you bought this year and what you plan to buy: equipment, vehicles, leasehold improvements, technology, and so on. Share that with your advisor along with realistic profit projections. Step 3 is structure. Work with your CPA to decide which assets to target with Section 179, which ones might be better suited for bonus depreciation. Get that plan in writing so you are not making rushed decisions after the year is over. Why the right tax advisor matters. Bonus depreciation and Section 179 sit at the intersection of tax law, business strategy, and real estate planning. The rules change, certain assets fall into gray areas, and the interaction with things like cost segregation, 1031 exchanges, and real estate professional status can be complex. An intelligent consultant discusses more than ticking the checkboxes on a return. He or she helps you think in multi-year terms and transforms these provisions into a coherent plan rather than just a basket of random deductions. Action steps. If large equipment, vehicle, or improvement purchases have been made this year or are about to be soon, then now is the perfect time to get ahead with this conversation. Do not wait until the return is due to find out what could have been done differently. Talk to a tax advisor who understands bonus depreciation, Section 179, and how they fit into real-world business and real estate decisions. To convert complicated expensing rules into a simple, actionable plan, visit GavTax.com and book a consultation. We'll walk through your situation, explore the available options, and help you select a path that supports your cash flow today as well as the long-term growth of your business. See you in the next video.